Alphabet just dropped 8%, and not just because of a major antitrust lawsuit that they're having, but also because Apple is bringing AI directly into Safari. That's a big threat to Google search, as of course, a lot of their target audience is on Apple. So is Alphabet still a buy? We'll break it down and we'll give you the value to answer this question. Let's go. All right, welcome everyone. Today, as per usual, we'll break it down in our three sections. So, what's in the news? We'll go over the fundamentals of the company, and we'll leave you, of course, while you're here, with the valuation of the company. So, Kirill, can we just break down the news real quick on what just happened
Yeah, of
and
course
why
we
it
can.
dipped and why it bounced back?
Yes, of course. Yeah, basically, probably about a day ago, there has been some situations going on with regard to Safari, the browser of Apple, and of course, as you can see in this news article, pretty much it's even more troublesome situations happening to Google and its stock. Not only the antitrust lawsuit happening, but also Apple is saying that apparently there are less Google searches on Safari browser for the first time ever. That happened in April. Bad news. But also on top of that, Eddie Q, the senior vice president of services of Apple, also said that, oh, you know what? We're actually going to explore some AI opportunities with regard to our search in Safari. And it doesn't include anything or nothing related to Google partnership. It's only about OpenAI, Perplexity, or Anthropic. So that's why the stock, it dipped quite significantly yesterday. Of course, it already has recovered as we're speaking of 3%, which is a good bounce. But then again, it just sparks another question of: is it a good buy? Is it a buying opportunity still? Because Apple has still decreased its shares for the past 5 months. It's down more than 17%, which is quite bad news to see. So let's look into it a little bit in further detail, shall we?
Yeah, let's go. All right. So, as usual, we will go over the fundamentals within our own 930 web app. So, Kirill, let's just scroll down a bit and just see what we're dealing with here. So immediately you can see the company foundations, and we see that they check the revenue growth 23%. That's a lot, especially for such a behemoth of a company like Google. They have their fingers in everything that's digital, but it's good to see that they have strong growth. It's actually quite impressive. The net income growth is also growing at 30%, so they're not only increasing their revenue, but they're also doing it more efficiently. So really good signs there. Growing the cash flow, free cash flow at a massive rate. So really good. All green across the board. I don't have anything else to add. Also buying back shares. They don't have dividends, but that's fine. They're giving you value through the share buybacks. So all good. And they don't have a lot of debt. I mean, yeah. At least they're covered on that regard.
Yeah, indeed. And also it's good to see that the margins are pretty great so far, and as any other big tech company, to be honest. So almost 60% on gross margin and above 30% on operating margin. That's always good to see, indeed.
Exactly. And we can also just quickly mention or just quickly check a bit on how much of their revenue goes to Google Search, and that's something that is a bit worrisome. So they do have a lot of growth, as we just covered, but we don't understand yet, for example, how much of the growth comes from the search. That is 57% of their whole revenue basket. That's it. It's a huge threat. I'm not sure that's something that you as a viewer need to do your due diligence on. So like how many users come from Apple devices or from Safari in order to conduct those searches. That will be the real threat. So then we also need to consider, and we'll go over that in the valuation, whether or not it's feasible for them to sustain such a growth considering these risks.
Yeah, fully agree. Nothing to add, to be honest. And then again, especially the search is more than 50% of the revenue, and Apple takes probably at least a third of it, probably even more, because on Android devices you have way more different models, way more different OEMs and everything, so the manufacturers. So it's still a big piece of a pie, and if it's gonna start decreasing, then it's quite worrisome. But then again, the question is how many of these kind of situations Google went through over the past years. So they're still going strong. They're still trying to innovate, especially with Gemini. Okay, Microsoft came with ChatGPT with OpenAI partnership very well, but then the rate with what Google managed to release Gemini and keep on bringing the improvements is also quite good to see that even though it's such a behemoth, they're still able to react quite quickly to such big changes in the environment.
Yeah, exactly. It might be fun to do a deep dive in the future where we just go over what segments of Google are actually growing the most. I think will be really interesting to see whether this 57% of their revenue is also something that they see in the future still growing, or whether they are already focusing on something else.
Yeah, fully agree.
All right. Well, but that said, we can only look at what we have at our fingertips right now, but it gives you a clear indication. So we can just quickly scan these ratios. We see, for example, the research and development being below 20%. That's good, especially with the money they're spending on all kinds of projects that they're running. I mean, slightly above 20%, but around the ballpark is where you would like to have it. Net earnings, net earnings ratio is above 20%, so that's also really good. Kirill, anything to add?
Just only, I think probably even the most important parts that you can see are that for the revenue and for free cash flow growth, you can see that it has been declining over the past 5 to 7 years. So of course it has been enjoying way better results back in the early 2000s before the lovely market crash, but ever since it has been even going down to 9%. So of course it's a huge company and it's really hard to keep on growing with the same rates as it was before. But then even then again, we're talking about no less than 9% back in 2022. So that's good to see. But then it of course would also have an impact on your bottom line with your free cash flow growth, which even has been negative in 2022. So I would say just be careful on that. That's something that is not really good to see. But I think what Robin has also mentioned, that they have also started buybacks of their shares in the last 5 years. That's good news. That's good to see.
Mm-hmm. Exactly. Good. And these are also looking pretty good, right? Operating profit, high gross profit margin, insanely high. Is at around 60%.
Yeah.
Nice.
Yeah. And then again, because they still have good profit margins, they also have good returns and they also have good cash conversion, which is also quite good to see. So it still means that their operating model is quite efficient. So they're still bringing the value to the shareholders, and that's who you might be potentially if you're interested. But then the question is, what's the price? Show me the money.
Exactly. So as we discussed, what do you want to pay for this company, and is it the right time for you to jump on it? So for example, I think for this case, let's just keep the assumptions on a low basis, right? Because it's tech. As you can see, it's like highly volatile. You never know what's going to happen, especially at the rate that AI is developing at this moment. So let's just keep everything at like 3 years, at least for our assumptions, so we can have a bit more clear picture of what's happening. Because if you zoom out, you will also see that these things will probably be higher, right? Because that's also what we saw at the foundations of the company. The revenue growth was high 20s, I believe, overall, if you do the max.
Yeah, max 21 years. Yeah, that's what we have in our database, in our app. But it's, of course, it went significantly down over the past 5 years.
So let's just take the 3 years so we have a bit more clear view on what to expect. So, free cash flow starting point, let's just take it from last year as we do regularly. And the projection period, Kirill, what do you think? Because to be honest, I don't think that Google's going to go anywhere, but I think it's more of a question of what are the growth numbers going to look like in the coming years.
Indeed, yeah, I fully agree. So I think it's solid to say that for the 5 years, it's not going to be affected that much. Of course, the developments with AI are quite significant and they're quite rapid. But then also you can see that Google is trying to provide their own response. in the face of Gemini. So they still have, I think, pretty good chances, and especially if it's a capability that they have in house. I think they still have a lot of chances to keep on improving it. And of course, with all of these data sets that Google has, with all the ads and everything, there's just have infinite possibilities to make it better and better. So I wouldn't be really pessimistic. I would even keep it at 7%. But I think maybe we can just further compensate it with the margin of safety, with all the risks that we discussed.
True, and also now I think of it as well as like, will you probably or potentially use ChatGPT to buy products? I mean, maybe at one point, but I think it's way more convenient now for Google to have the ecosystem just to show you the options, whereas ChatGPT or other AI languages are still a bit floaty on that, especially if you ask them to look stuff up on the internet. I mean, that will come a long way, and then also we need to consider in which stage are the customers? Are we at the infancy of AI, or are we already in the early adopters or early majority, for example? That's something that as an investor who might want to look into Google, right? You need to figure out at what stage are we. But like if we look at it optimistically and we say, okay, we're at the early adopters phase, then 2 to 7 years, discount rate real 10%.
Yeah, pretty much as usual. And something that you would usually put in as it's also kind of rule of thumb for all the stocks that we value.
Then for the estimated growth rate, so here it says 7%. I can quickly check what Yahoo Finance has to say about that.
Sure.
It's probably going to be weird, but we will look into it anyways.
Yeah.
So they say it's gonna grow next year with 6.666%. Current year 18%.
Current year 18%.
Yeah, wow. So it's gonna grow 18% this year. So
okay.
That's also quite a tough target to beat for Google. But
then again, look, we can just come back to it, and then you can just put max. We can say for the average 21 year, and then if you've seen that the rapid growth was before 2009, that was the best years, let's say, of Google in terms of rapid growth. What should happen? And again, as Robin said, that's only for this year. And we're also projecting for the upcoming 7 years. Would it be realistic to project that for the upcoming 7 years? Definitely don't think so. Definitely.
I would be more comfortable more comfortable putting this somewhere around 5%. Just be a bit more on the pessimistic side of things.
Yeah, we can, and then again, we can always adjust the assumptions, and that's also the magic of 930 tool. We can always just play around and see what suits you best in terms of your understanding of the company and the fundamentals and everything. So yeah, why not? We can start with that.
Exactly. Cool. So PE ratio 24 seems about right for tech.
Yeah.
Right.
And it's also the averages for Google. So yeah.
It didn't really change much though.
Yeah, again, apart from back in the days when it was crazy growth, it was PE of up to 58, which is even then it was of course expensive, but now whenever you see some crazily overvalued tech, it's like it's all right. Yeah, that will do.
Exactly. Required rate of return. Well, we always say that you want to try to beat the market a bit, so we need to be around 7 to 10% because that's what you're probably potentially making ETFs. So
yeah, correct.
10-11% should do the trick. And then for margin of safety, there are already a couple of these potholes basically that we discussed, right? These booby traps in the company that they haven't discussed yet, but we already see like this could be potentially harmful, right? So we don't know what Google thinks is going to be their most, or which business unit they're going to grow the most, or they're going to develop the most. You can probably find it out, but we don't have time to look into that today. Also, high uncertainty on how they are going to fix the thing with Apple, if that's going to hurt them at all. There's a lot of uncertainty around this, and also just to cover ourselves, I think 30 or 40% will be just fair.
Yeah, I think so. And then again, what's kind of beauty about the whole tech environment is that it can be so unpredictable, especially on a small scale, like when you have like some small tech startups and everything. But they can even eventually can rapidly become one of these big FANG stocks pretty quickly. So it would also affect everyone, not only Google, not only Apple, not only Microsoft. So it can be happening to everyone. But yeah, bottom line is, so you wanted to put it at 30, right?
Yeah, 35.
Okay. Let's try 30. Let's just have a look. Yeah, sure. I think it's very reasonable. And it's especially if you're risk averse, then yeah, of course, it probably could be a little bit of a tricky stocks for you to invest. But yeah, so we hit the analyze button, and then we can see what are we talking about.
Oh, it's actually not. It's not that bad. I mean, it's twice of the target buy price, which also considers the margin of safety. But I'm not really shocked about the average valuation, to be honest. I thought it would be a bit worse.
I think, to be honest, I kind of agree with you on that. But it would be also really a question of if Google would be able to improve their free cash flow growth. Because then, of course, if you also adjust the projection period, and if you, for example, also reduce your required rate of return a little bit, so I don't know, 9 or 8%, then of course the average valuation is gonna bump up. And then again, guys, keep in mind that these are rather conservative / more or less realistic assumptions, right, that we're putting in here. So our assumptions could be completely different from yours. So again, what you gotta do your due diligence. And
exactly.
Yeah,
and we also had a couple of comments back in the days where people also mentioned that, for example, with this method we would miss out on certain opportunities, but then we're also calculating growth besides just having assets and besides having the fundamentals. So really utilizing this, and if you do more due diligence and you're able and you're more comfortable with, like Rue said, bumping up these numbers, then you'll get really close to a certain valuation that's really fit for you, and then you can make your decision based on that.
And also on top of that, for example, what can happen is that if you're interested in the field and you, for example, have more knowledge about certain things, your assumptions can be different. But also on top of that, if you find this company having a great moat or have great competitive advantage, you might be also willing to pay a bit of a premium. That's also fine, because that's, for example, what I do from time to time with certain stocks. And that's okay, as long as you just understand what kind of premium you're willing to pay, right? So for instance, in this case, you would be paying $40 per share on top of it. So you just have to answer the question of, are you willing to pay that price or not? That's just simple as that. And this is also something for you guys to keep in mind in the future.
Exactly. So basically with this valuation method, what we're trying to figure out is like, what is the best value where you basically cannot lose any money. And in a perfect world, it's of course not possible, but we're at least giving you a framework for you to understand more and to find the right metrics in order to find a good value for the company at a price that you're willing to buy within your margin of safety. Those are the unicorns that we are after. But with that said, Kirill, where can these people get the web app?
You mean the lovely gentlemen who are watching this video, and thank you. And hopefully we're going to be more consistent also uploading. So we aim to publish every Thursday. So stay tuned, and hopefully we're going to be delivering for you guys. But always, of course, we would be looking for your feedback and for your comments. But yeah, sorry. You can get it if you go to 930.com. The link is going to be in the description. It's pretty simple. So you can just check out different plans we have. You can even start for free. You can check our demo environment. It's no subscription required whatsoever. You can just bump in, just click on that button, and it will just show you some basic overview. Or you can also just even get more. For instance, you can get a watch list with this, and you can also get a newly built feature that we have recently created, which is a stock screener, where you can basically efficiently fish out different companies based on different metrics. And we're also affordable, guys. So it's not like we're asking for some crazy money like this big crooks, big corporate guys who are really want to squeeze you. So if you're really interested in more value-based investment approach, and if you want to start with pretty low cost basis, that could be a good advantage for you guys to check out the 930 app. And I'm not trying to sell it. I'm just really trying to be realistic, to be honest. Because if I had it when I was starting investing, I could probably save a little bit of more money, to be honest.
Exactly. All right. And with that said, thank you for watching. Thank you, Kirill, for your lovely insights. And we'll see you guys in the next video.